What's up, everybody? Michael Silva here. So the S&P 500 posted its worst first half of the year since 1970. However, not too bad of a start for the back half of the year. We talked about this being the most bullish day of the year, and that's based off of statistical analysis, looking back at July 1st, dating back 21 years, thanks to the Stock Traders Almanac. And even though the market started in the red, it did start picking up towards the end of the day. All the sectors were in green, hallelujah, going into that holiday weekend. But I will say there's still, utilities being a defensive sector was the leader in all of that. And there's definitely some things to worry about moving forward in the markets. We're going to be talking about that today. Mainly here, you got the yields to be, mindful of, right? An inversion looks likely again with the 10-year and 2-year yield, which basically, if you don't understand why that's important, that's not good for financials, right? So financial charts don't look all too hot, but, they borrow short-term, they lend long-term. And when you have a 2-year yield at 2.84, and then you have the 10-year at 2.88, why not get yield on a 2-year versus 10-year when it's, we're talking about 4 basis points or 0.04 away. And then if you take a look at the 10-year and the 3-month yield curve, this thing, the rate at which this is moving to the downside looks like it's going to matter here soon. But that thing is falling quick and fast to the point of inversion. But it's not just that, right? We also have Q2 earnings season, so be on the lookout for weaker performance. A lot of analysts are suggesting that there's going to be weaker guidance, weaker performance going forward. So there's just a lot of things to be considering. And now, if you're new here, well, welcome to the show. If you're not, well, welcome back to the show. This is the Stock Market Brief Show. We use technical analysis, intermarket analysis. I'm going to have timestamps in the description below. We're going to be going over quarterly charts, monthly charts, weekly charts. We're going over expected moves today, indicators. I'm going to be explaining a little bit more about the VIX. We're going to go over some intermarket stuff and also some opportunities out there in China as well. So got a lot to talk about. Now, before we get into the show, I want to quickly talk about the Swing Trader platform that I have set up on Patreon. You can look at the pinned comment or the link in the description below. It's $9 a month. You can join into our group, right? We have a Discord group, chat community, some general support. You get access to all the private Discord channels. I give out swing trade setup ideas. We give out the weekly watch list and also the expected move list too as well. We have a great chat community, some great chartists in there as well. If you don't want to pay the $9 a month, you can just do it annually. That's probably in my opinion, that's a better way of doing it. One, it's $90 or something like that with a 16% discount, which ends up being like $7 and some change. So it's pretty inexpensive for the amount of research that I put out there. Every once in a while, I'll put out an educational video too. Like just July 1st, I posted this educational video. This is just slowly grow a trading account. And I kind of just walk through my position sizing, how I kind of my approach to the markets, and I gave out a couple Excel documents to help calculate and do that kind of stuff. Let's go ahead and just hop into today's episode. What's up, everybody? So I want to start off here at the VIX chart. I was going to start with something else, but we've been talking about volatility and how to interpret it when it's actually at a high reading. And I don't feel like I've done a good enough job to kind of like walk you through my thought process, how I perceive these numbers and what they actually mean, right? So volatility, VIX is at 26.69. Okay, what does that number mean? What does it mean to you? What does it mean to a trader, investor, portfolio manager? So I'm going to give you, a quick rundown on what it is, why it's important, because Russell volatility, the NASDAQ volatility, they're in their 30s, all right? And then you have the VIX. Remember, we talk about if it gets above 30, watch out, everything could get hit. Okay, so we close at 26.9. What does that even mean? All right, so in order to know what it means, you need to know what the VIX is. And the VIX is a measurement of implied volatility of index S&P 500 index options. Okay, it's the expected movement in the S&P 500 index over the upcoming 30 days. But understand, it's then annualized. Okay, so this 26.9 number represents an expected annual change of 26.9% over the next 30 days. Blech. Okay, right, so what does that mean? So if you take 26.9% and you divide it into a square root of 12, that will give you an expected move, what the options market's pricing in the next 30 days. Okay, and what does that come out to? It comes out to something like 0.077. Okay, so that 0.077 is basically saying 7.7%. Okay, so this is also, we talk about weekly expected moves, right? We talk about those frequently. They're priced with the assumption that they're going to close within 68% of the times, be accurate, which is one standard deviation. Okay, so 68% of the times the VIX is going to be right. So basically what this is saying in essence is there's a 68% likelihood that the S&P 500 is going to move less than 7.7% over the next 30 days. Okay, that is what that number is saying. The next question you should be asking yourself is, why is that actually important? This is important to know because if you don't quite grasp the volatility of the index going up, what does that mean for your portfolio? So say if you're trading a $100,000 portfolio, all right, maybe you run, all long, maybe you do long short, maybe it's long term, maybe it's short term, who knows? But if you are, investing while, the VIX is down below 15, what this is telling you is, if you do the math, right, this is around 4.3%. If you do the math, what I just stated, that's basically saying, okay, you have $100,000 in the market, okay, and you're used to the VIX being around under 15, and that's basically stating that the market will only move around 4.3%, 68% likelihood of doing that up or down, okay? However, if the volatility all of a sudden doubles and you still have $100,000 in the marketplace, your risk is doubling too. So this 100,000 technically turns into 200,000, all right? Which just basically means you have a lot more risk out there because the volatility is very well increasing. So if you're aware of this and you know this, typically what happens is people will say, okay, can you hedge? Yeah, you can hedge, but that's also increasing your exposure too. So what you could technically do when you notice that volatility is rising, you can exit positions. You can lower position sizing to make up for the increased volatility, obviously, in the markets. And as we've already stated previously, when you start getting above 30, almost anything could get hit. So hopefully that kind of helps explain just, very subtly what number you're looking at here. But just keep in mind, volatility is still high, right? We closed here at 26.7. NASDAQ volatility, it's been above 30 for quite some time. All right, so if you're going gung-ho in the with options, with your portfolio, you're seeing large swings, and that's because volatility is obviously so high. Okay, this environment, what's so good also, and same with Russell volatility, what's so good about knowing this too is because this is also letting you know that the environment of the market is changing. All right, so when the volatility is higher, that is a day trader's favorite dream, or a trader's dream that trades short term, 1 to 10 days, 1 to 5 days, because they're holding a short term for quicker pops, and those pops can be significant. However, when it's above 30, this is portfolio managers' worst nightmare because volatility increases and they have to run a complete, like a long book. They have to be fully exposed to the markets. So this is, very important to know, especially as a retail trader, because if you're aware of this, you can start positioning yourself, you can start managing risk a lot better. I'm going on a little bit of a tangent there, but I wanted to kind of get that in quick just so you understand kind of the concept here. Let's hop into quarterly charts. Let's look at the big picture. Where's the market going? We'll talk about it. Quarterly charts, we just had a quarterly close below the quarterly 5 EMA. That doesn't happen often, okay? And I pointed this out before. It's happened, but typically every single time that it's happened, the Federal Reserve steps in, pivots, does something. You can look here, 2020, unlimited QE. You got back here with the repo fiasco. You have the China stock market turbulence over here. This was, I think, Operation Twist, QE2. There was a couple of things that here, and it wasn't, QE1 wasn't initiated until basically over here at the bottom of the financial crisis. Okay, but you can see here, bam, we had one close below it, and guess what? The Fed didn't step in right away. We had a financial crisis. One stop below it, bam, we had the dot-com bust. Okay, well, if the Fed is going to be tightening in this environment and they, seem like they're going to continue that path, are we going to continue this downtrend? History suggests that, yeah, we will, unless if they pivot and then maybe we can, something else will happen. We also have a quarterly crossover too. Okay, so that's something important. Don't put way too much weight on it, but it's something to be mindful of. You need to understand the difference between a bull and a bear market, because that'll help your also positioning going forward, right? So right now it's more of a bearish bias, obviously, than a bullish bias. Okay, let's take a look at a NASDAQ composite. Clearly it's in a bear market. We're disconnected from the quarterly 5 EMA, one of the most frequently tagged EMAs, and you can see we closed well below it. Like I said, we had a decent start to the back half of the year, and we're coming into earnings season. So NASDAQ 100 also, bam, closed below that quarterly 5 EMA. And by the way, you can screenshot this and mark these numbers, because the quarterly 5 EMA, if the price wants to start running up to it and you're playing tactically for a bounce, that could be an area to watch out for, because that very well can act as a level of resistance as well. Remember, the slope of it's pointing down too. So that's IWM, and here is the New York Stock Exchange, all below their quarterly 5 EMAs, and it looks like they want to try to get, come back to re-tag it and potentially test it as a level of resistance. Let's hop into the monthly time frames. You're going to see a lot of lines on the chart. I'm bringing in a couple of other things just to give you a good picture as to what the options markets are pricing in for the next month, for this month. All right, and then also for the quarter. Okay, and then you're going to see some red on the screen too. I'm going to talk about that momentarily. So this dash line is the quarterly expected move. This is what the options market is pricing in as far as, hey, where can this market move this next quarter? And it's basically saying, hey, we can come back down here, which is the pre-COVID high. You can see, right around 3,300, and then we can potentially come back up to 4,200 too. If you look at the monthly time, the month here, that's the solid black line. That brings us up where? It brings us right back up to the monthly 5 EMA at 4026, and then also potentially to 3,600, which is the lower Bollinger Band right there too. Okay, so that's saying, hey, we expect the market to move within this. In 68% of the time, the options market's typically right. Okay, that'd be one standard deviation. So why are those levels important? Well, they're important because if you're starting to go long and you start watching price come up to these levels and you see a monthly 5 EMA and that's also the expected move, or it comes up a little bit further up into this area and it gets there somewhat fast, well, then you can be like, okay, well, it's already reached its expected move. The options market's pricing in. Perhaps this is a good area to take profits, or start to position myself for potentially a leg lower because of the context of the market. We are technically in a bear market. Now, I want to continue on. This red shaded area on the screen, what is this? This is bear market territory, right? So this was the high, and then you multiply that by 0.8, right? And that'll give you what's 20% lower, and that 20% lower brings us to this red line, and beneath it all the way is bear market territory. And it depends on how you identify what a bear market is and a bull market. I personally, so a bear market is when it falls 20% down from the high. And then on the news, you'll hear like bull market is like 20% off the bottom. I don't necessarily think that. I think that a bull market starts when we get back out of the bear market levels. And like if you look at 2008, it did something very similar, right? We came into bear market territory, we fluttered around for a little bit, and then we flushed. And it wasn't up until we came back into the previous bear market start to get into a bull market where it kind of doodled around, came back down a little bit. But that's telling you as an investor or as a trader that, hey, this is where we can start positioning ourselves more of a bullish bias at that given time, okay? So just kind of a thought process there. So that's the S&P 500. If we take a look at the Qs, you can see here quarterly expected moves in the dash line, and we have the monthly expected move there. That lines up with the monthly 5 EMA. So if we come up, rapid and sucks in a bunch of people, right, it's good to look at these time frames, because then you'll be like, oh, well, actually, I remember 304.70 on the Qs is actually a potential area of resistance because we're pulling into a downsloping 5 EMA, and that's actually what the options market priced in as a potential max move of the Qs, okay? So that comes up to just around like 305, right? And then you can also look at the downside too as well. If you want to look at those numbers or just whatever, just screenshot this. And then IWM's also deep into the red territory, which I didn't show you that on the Qs here. You can see the bear market was way down here. So, you want to get above, which is actually interesting, right? So the quarterly time frame or the quarterly move, it's actually in the bear market territory. So even if we move up to tag the very top of the quarterly expected move for this entire quarter coming up, that's still in bear market territory. Okay, so this right here is when would we be in a bull market? Well, that's when we start getting back above the 20% dip right here, which is just 320, 325-ish area right there. So once we start having some closes up there, then we can say, okay, now let's be a little bit more bullish bias. But as it stands right now, it's definitely bearish bias, even though that we might still bounce at this given time, which we'll go into indicators here momentarily too. IWM, you can see here too as well, deep into the red territory. The quarterly expected moves gets pretty deep. The monthly expected move can get pretty deep. And you can see here that both of those expected moves for the month and the quarter are still under the bear market territory. So that is not the greatest look here for Russell for small caps. Let's hop into the weekly time frames. If we take a look at the S&P 500, I went ahead and left the dashed lines on there, which represent what? That represents the quarter. You just get to see more candles, and that represents the month here too as well. So in the S&P 500, we're slightly in bear market territory. We're fluttering around in that area. Like I said, that's very similar. If you go back to 2008 and you measure 20% down from the peak, it did something very similar, and then we saw the big move. So right now, as it stands, as far as the bear market territory goes, I pay very close attention to the bias on the bears side for the NASDAQ composite and the Russell 2000, because you can see the S&P 500 is still trying to hold itself up. But we are below those key moving averages too as well, okay? We'll get more tactical here momentarily. Let's first go to... So the Qs, there we go. So I show the S&P 500. Here's the Qs. You can see deeper into the bear market territory. It came into a declining 10-period moving average, which is the 50 daily moving average. The 10-period weekly is about 50 on the daily, okay? So if we start getting a big rip to the upside, we'd still technically expect a move would be in bear market territory, as we previously stated, and we have some declining moving averages. So a lot of pressure to the downside, which tells you what? To be more bearish bias, to sell the rips, right? And cover on the dips. So it's a shorting a market. Let's continue on to the IWM. Similar situation, came up to that declining 10-week moving average, got rejected, and closed down underneath the 5-weekly EMA. It's been getting pretty hammered here too as well. Let's continue on. I also want to show the Dow Jones Industrial Average. We talked about these 4 rallies here on the week, how they basically opened and then closed at the high, opened at the low, closed at the high, open, low, close, high. And we're like, is it going to happen again? And well, sure as heck, it opened at the low, closed at the high, and then we saw some weakness come stepping right back in, and we saw it with increasing volume. So pretty weak overall. We'll see here if we can capture that 10-period weekly moving average. And if it does, that opens the door to at least test this high right here and potentially the declining 40-week moving average, which is the 200 daily moving average. But we'll continue to monitor that as time progresses. Let's hop into the expected moves for each of these index products here. First and foremost, this was last week for the SPY. That's this week. So last week, this week, what do you notice? Lower high, lower low. Where can it potentially go to? Around 390 for next trading week. So it's a decent size range. Keep in mind that it's a shortened trading week because of the holiday. But you can see here, right? We had a distribution day step in. We're still below the key moving averages, but this low is still currently holding. This little candle right here came in with some volume as it hit and tagged that lower expected move. For the prior week, if you see here, you can see we came outside of the expected move for the week and is basically barely holding on, and we closed just right back in with side of it. Remember, 68% of the time it gets here, but the last 4 to 5 weeks prior to this week, we were actually closing almost 2 standard deviations outside of the expected move. So the options market just wasn't on point, I guess would be a simple way to point it. It's usually very efficient, but we've been hitting 2 standard deviations outside of what they were expecting. So obviously lots of volatility in the market, okay? If we look at the Qs, they close outside of the weekly risk range, but they're basically just right there. We got pretty deep outside of it, but the market ended up coming back there. July 1st, right, one of the more bullish days. It started down and then we closed up around the high. So we'll see here. That was last week's expected range. That's this week. Last week, this week. Last week, this week. What do you notice? Last week, this week. Lower, low, lower, high, okay? And it's compressed range because, well, it's a shortened trading week. So we start moving up to the upside. Look at 290 for a potential area to fade it. If we start going to the downside, 270 272, right around that area, which would be kind of a retest of this potential low. So it's always important to watch that low, because if we get a hit to the downside, look to see if it's just an undercut. Because keep in mind, this chart actually looks like it's wedging, but I'll talk about that on a later chart. Let's look at the IWM. Last week, right, we came outside of the expected move, came right back in it. So if you took that as a trading opportunity, despite seeing all the fear out there, you were able to catch a little bit of moves here. That's this week. Last week, this week, lower low, lower high. Where can it go to? Potentially right up to test this previous swing high right here. So we'll see. And then keep in mind on the lower end, it's, if we come, just like I said about this low right here, if it undercuts it, keep in mind to look for strength coming out of an undercut. But if it takes it out and it holds with big volume, that's not a good sign there for the IWM. Let's take a look at some indicators. And by the way, on Tuesday, I'll bring in the 15-minute charts to get a little bit more in detail when we have more data. But now let's hop into some indicators, because the indicators, as it stands right now, there's actually some bullish developments. So to me, it looks like we can see some potentially short-term bullishness. What do I mean? Okay, let's look at the CPC put-to-call ratio. I use this as a buy and sell signal for the most part, and we put a 10-period moving average over it to smooth out the data. The data in the background, that purple line, that is the put-to-call ratio. The black line is the 10-period moving average. You can see how it smooths the data out. Now, what's cool here is we talk about when it crosses from underneath the red line to above it, that's a sell signal. Well, the last sell signal, we got a couple of them. I called this a sell signal too, if you go back to my videos back then at the beginning of 22. But then we called out this sell signal too. That was the market top, okay? And then we started getting buy signals. Buy signal and a buy signal. What's a buy signal? It's when it crosses above the green, down, back through the green. And you can see, boom, we saw a little rally right here. Bam, we saw a rally right here, okay? That was that big, big bear market rally. Now what do we see going on? Something very interesting here is notice how the put to call ratio has been putting in higher highs and higher lows, and how the S&P 500 has been putting in lower highs and lower lows. Okay, and when the put to call ratio rises like that, you can see the S&P 500 has been falling down. There is something interesting though that has taken just place recently that I want to point out that I don't think anybody's really pointing out. So look at this high, and this high. Those highs all correlate with a low, and a low. Now take a look here. This is a lower high, but this is a lower low. So you can see here we flush down pretty hard, but it's not represented in the put to call ratio making another high. Now you can see the put to call ratio, if it starts heading down, it's not going to be too far off of a potential buy signal. And if that is the case, we'll be ready to deploy some capital. And the reason why is because, well, we've seen previously some bear market rallies come. And even if the market, and even if you don't want to go long necessarily, you can be aware that it might not be the best opportunity to short. So the reason why I'm pointing this out is it's not there yet, and it could change, right? This can fire back off, and this can move up with it. But I'm pointing out the divergence now, so you're aware that, hey, if the 10-period moving average starts getting below 0.95, maybe even sooner, this could have been some sort of flush out where we find a bottom or do some sort of bear market rally before we start getting more weakness. Okay, another thing that I want to point out is the old fool indicator. This is where we want to watch the green line cross above the blue line, and it's just not there yet. Okay, and you can see that when it crosses the green line through the blue line, you get weakness. Green line through the blue line, bam, you get weakness. So we're waiting for that trend to change. The last time we talked about that, I pointed out this subtle divergence here where it had a low and a higher low, but then the composite, the NASDAQ composite, had a low and a lower low. So that to me was like, interesting. Maybe that's perhaps telling us that we might see some strength. Look what the NASDAQ composite did. We rallied up, okay? So we'll continue to watch this, because if this line starts getting up and then the green starts crossing the blue, that can also indicate that we might start seeing some sort of a rally, some sort of seasonality for, summer rally, something take place. So it's something to be aware of. It's not there yet, but it's something to be aware of. Another thing is the trend indicator, or sorry, not the trend indicator. This is the SPIP over GOVT. I use this, I found it randomly that when the rate of change crosses up through about 1.3, it gives you an insight to potential volatility increasing around the corner. The last time I pointed this one out was right here. Bam. And I called it out on Twitter. I called it out here. And look at what volatility did. kind of took off sideways to down slightly for a couple of days, and then pow, just shot off like a rock. But the reason why I'm showing this now is because I noticed that the relative strength line between these two has been falling pretty rapidly. And then I looked at the rate of change. I was like, okay, that's fallen pretty rapidly too. When's the last time we've hit these levels and what has it done? Well, when it comes down to around -2, look at what volatility does. It sinks. This one kind of popped up but then came back down. This one right here, fluttered up but then came back down. So, I don't put too much weight on it, but we crossed down through it and look at what volatility just did. Came up, but then we just had a big crush to the downside. And if I look at things like skew and the VVIX, which is volatility of volatility, the VVIX is another closing low, and skew is getting low too, which tells me there's just like a lack of hedging, a lack of, I guess, fear in the market, I guess would be a way to put it, or doubt. So I found that interesting because there's a couple of things lining up here. I'm like, maybe there is going to be some sort of rally despite all this bearishness going out here. But just be mindful that, hey, earnings season, that can throw all of this off. And there's, like I said, as I started with this show, the three things that were kind of big red flags, and that was the yield curve. It was earnings season, earnings guidance, and obviously the current structure of the market is still in bearish territory, so you have to be more bearish biased. Pring bottom fisher. The pring bottom fisher is starting to curl up right here. Boom. Okay, the last time we talked about it curling up right here, it led to a nice rally. Okay, well, it's starting to do it again, so I'm just bringing it to your attention. Does that mean it's going to be a rally for sure? No, it doesn't, but at least be aware of it, okay? And then the next thing that I want to call out here is the summation index, NYSE summation index. And this is interesting to me because you have a subtle, well, first off, the 9-mot, this is the NYSE McClellan oscillator. We talked about this divergence. We talked about this divergence, right? Negative to the downside, positive to the upside. But what I haven't called out yet was the positive divergence in the summation index, where you have a low to a higher low, a low to a lower low in the New York Stock Exchange. And what I like about seeing this right here is you can see the parabolic SAR coming in to the summation index piercing right here. So if the parabolic SAR starts down ticking underneath that purple line, it could indicate a change in trend. As we've seen here, it goes above it, we trend down. It goes below it, we trend up. It goes above it, we trend down. So if the parabolic SAR says, hey, comes down here, this might start heading up, which could indicate potentially a summer rally. Always a possibility. Keep it just in the forefront. Be aware of it, okay? But really, in theory, what this is telling me is, hey, price action got weaker, but the internals, there's some strength coming in. Okay, another thing I want to call out is the NASDAQ McClellan oscillator, right? We just recently discussed this one, which is the NYSE McClellan oscillator, and this is a traditional calculation. This is the NAMO, the NASDAQ McClellan oscillator, and I'm showing you in a different way because you can see overextended to the downside, overextended to the upside, and you can fade, but you can see here that wedge that I was talking about in the NASDAQ composite. You have low, 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 but there are higher lows, lower lows, and you can see the price action went from expansion and now it's contracting, getting tighter and tighter. However, while it's making these lower lows, you can see that the indicator here is putting in higher lows, which could potentially indicate a bullish divergence, stating that the selling pressure to the downside is weakening, which could potentially mean a bottoming process. Okay, and I use the word potentially for a very specific reason, because nothing is certain at all, okay? But it is something that I wanted to point out once again. Now, I show this indicator too. This is the S&P over TLT ratio, and then the S&P 500 below it. I call out negative divergences here where if this ratio puts in a higher high, but the S&P 500 doesn't, and sometimes that is a warning sign that the S&P 500 could fall. And you can see here it fell, and it fell. The reason why I'm pointing this out this time is because you can actually use it for bullish divergences. And I wanted to call it out here. I'm going back in time a little bit deeper, and I'm showing you a line chart so it's a little bit clearer on the eyes. But you can see if the ratio puts in a lower low, but the S&P 500 puts in a higher low, you can potentially see the S&P 500 rally. And you can see that was the case right here where we rallied up and then the COVID crash. Okay, you saw the same thing right here. Boom and boom, and then the S&P 500 rallied. You saw the same thing here, a lower low, boom, boom, S&P 500 rallied. And now we're seeing it again. We haven't seen it for a while. Now the candlestick made a new low, but this hasn't fully made a new low yet. A lower low, it's more kind of flat, but you can see the S&P 500 clearly has that higher low. So if this was to come down just slightly a little bit more, and this is, still a positive divergence here, it could be indicating that the S&P 500 very well may bounce, okay? So I thought that was interesting. If we look at some bottom fishing indicators, some more of them, right? We bottomed out here. Every time that we hit this 0.05 on the weekly time frame, we could see bounces. Well, we saw a bounce, then it started selling off, creating another low, but then we have a higher low here. Keep in mind, every time we've got these readings before, it marked bottoms, a 20% bottom, it marked it, 23% bottom, marked it. The long-term capital management, the dot-com bust. The only time that it was very sketchy was around the 2008 financial crisis, where we marked a bottom, it rallied, marked another bottom, it rallied, and then we crashed hard, and then it started marking those bottoms. So you can see a lot of chop at that range. And what are we seeing right now? We're seeing a lot of chop in that range. So be aware of that. And if you look at the NASDAQ record high percent index, this is another good one. If it starts getting below 20, and then you need to be patient and wait for it to cross back above this 35 reading. If that's the case, it's marked out bottoms in the past too. Long-term capital management, dot-com bust, financial crisis, and then we have some more bottoms that have picked out, and you can see here it hasn't even started turning up, indicating that the market is still rather weak. So if we start seeing this turn up, get back above 35, it could very well mark a bottom in the markets. Another thing to pay attention to is obviously the percent of stocks above the 50-day and 200-day. The other day we were at 2%. We're back up out around 24 now. So that was a pretty fast move from 2% of stocks, above the 50-day moving average, which tells you 98% of them were below it, and now we're back, 24.2% are back above it. So we're seeing, what does that mean? We're seeing some breath come into the marketplace. We're seeing some stocks see some relief and start to move. So if we are trying to find a bottom, right, be aware of these indicators, be aware of what's taking place, look at individual stocks building bases, which we've been discussing throughout these episodes, okay? So let's continue on. Another thing that I want to point out is HYG. HYG has been getting completely hammered. However, one could argue that that was a double bottom, so if it gets above 75, it could rally. MACD is starting to curl over a little bit. The histogram just turned positive for the first time in, quite some while. We have, the RSI starting to point up, but it's still below 50. So if it does want to start moving up, chances are the S&P 500 and risk equities will probably move up with it, because there is a pretty high correlation there. Let's go ahead and hop into some intermarket things, some commodities and so forth. I've been talking about gold. Gold had a very interesting day, right? It flushed down pretty hard, retested this previous low. Doesn't look all that strong, to be honest, but it put in a nice hammer candle. And if you look at the correlation chart, correlation to the dollar, you can see, you have a cup with handle pattern, inverse cup with handle pattern, right? So if the dollar starts breaking out, I think that's going to put more pressure on gold, unless if this correlation breaks, right? And then all of a sudden, they don't have a negative correlation anymore. The dollar can move up and gold can move up. But the thing that's holding gold back and miners, I think it's actually just the dollar at this particular point in time. And you can look at this from a risk, sentiment perspective. Like, okay, if people are flooding into the dollar, is that just a way of going into safety? And it very well could be, because we also saw the TLT start to rise too. However, it's still consolidating sideways. So if the dollar starts breaking down, it's going to send gold up, I think, in my opinion. So we'll continue to monitor that and watch that. I want to get a little bit more in depth with that. If we take a look at, for example, silver. Silver has been getting pretty beaten up. Now, this is a monthly chart of silver, and I wanted to call out that it's pulling into a previous area that was, resistance, but when it broke out here, we saw a big pop, which could indicate that there's some demand. It's an important level right around that 1870 marker, and we're coming into that ends up being around the 61.8% retracement level too. So this is important to pay attention to. If we look at like the SLV on the monthly time frame, we have a bearish crossover, so we have some wind at our face, but you can see that it popped down to this 18 level, and then it started getting green on the first day of the month. So it's down slightly, but still it's something to watch as it's pulling into these prior areas. And you can see it more clearly here, how price tightened up and then volume expanded and exploded, indicating some demand here. So if you're looking to buy silver, this actually makes sense from a risk to reward standpoint. But it's more than just that, okay? If we look at like miners, okay, and this is another important thing, because I'll show you how they move hand in hand. But GDX, I pointed this one out actually to my Discord group earlier today. You have the price action flush below an area of that was prior support. And you can see it was a flush with some increased volume, potentially hitting stops out, okay? And it flushes people out, capitulates, whatever. But then the very next day, you have this gigantic piercing bullish candle. Has no confirmation yet, but it's something to be like, hey, we just had a, more volume come in, and we gapped down and then closed basically taking over half, of the previous candle, almost a full bullish engulfing, but it's called a bullish piercing pattern right there. Okay, so if we start getting above this high, that can indicate that this was just an undercut and we might get some sort of a rally potentially. And you look at like a positive divergence here, positive divergence there, right? We have a low to a lower low, a low to a higher low, which indicates that the selling pressure could be very well weakening, could indicate that we could get a pop, a bounce, something in the miners, okay? And then if you take it a step further here, if you look at like the BPGDM, this is a bullish percent chart. This is, moving into oversold territory, and this is a pretty low reading on the weekly time frame. We're getting down to around 15. We're between 15 and 20 at 17.24, which we haven't seen that since, around the pandemic, okay? The pandemic went lower, but we haven't seen this type of reading for quite some time. And when we've gotten these low readings before, we have actually seen some bounces too. So that is another thing to potentially here pay attention to. But the reason why I'm showing you, silver and the miners is because if you pay close attention, they do move hand in hand. So, if you're like, hey, I want silver or I want miners, look at the gray is silver and GDX is the brown, which is the miners. And look at the correlation between the two. It's almost like a 1-for-1 correlation. And if you just look at the chart, they move hand in hand. So if I'm right about silver finding some sort of a bottom or an area of demand and it starts moving up, it's likely to potentially watch miners do the same thing. So I know that most people's eyes, as it stands right now, traders, they're looking at biotech, because biotech's been basing, and they're looking at China stocks. No one really is talking about the miners, and that's because they've been getting completely and utterly beaten to pieces. However, sometimes when no one's looking, that could be a potential opportunity. Although, let me preface this, you need to still, be mindful of the risk, okay? If we take a look at the dollar here in correlation to the S&P 500, you can see a pretty similar type thing, right? If this moves up, S&P 500 gets crushed. So if this starts falling down, and I'm right, miners start going up, silver starts going up, gold starts going up. If this starts coming down too, potentially, like we said with these other indicators, indicating that the S&P 500 might be finding some strength here. So, if you're bullish, awesome. If you're not, like I said, we're still in bear market. So you need to be, obviously, if you're a bullish bias in a bear market, you need to make sure that you're managing risk, okay? If you are bearish in where we stand right now, and I'm showing you some bullish viewpoints, you might want to just be bearish, but be very tactical of how you position yourself, okay? Now, if we take a look at oil, oil is still holding higher lows at this particular point in time in this, compression type pattern right here. We'll continue to watch and see if it breaks down. It has to now get back above 115 to pop and retest that 122. If it starts breaking down the 100-day moving average, I think that opens the door to head lower for the price of oil, okay? Now let's talk about China, because this one is, this is important to see because we're starting to see some strength come in. So first and foremost, if I look at a relative rotation graph, we're looking at a 3-week tail length on just various different international ETFs. The one that stands out should be this big, thick green tail, which is EWH. What is EWH? That is a Hong Kong ETF, okay? And now if I were to I want this to be clear, instead of benchmarking it to the SPY, let's just look at more of a trend perspective, okay? So if you just benchmark it to the $1, you can get an idea of trend. And you can see here, pretty much everything is pointing down to the lagging quadrant, except for EWH, which is Hong Kong. So there is relative strength in China, and there's a lot of Chinese equities that look to be basing and setting up for potential moves. So that's why it's important to also pay attention to those. We talked about individual equities. DD was one that we talked about on the last video, and that thing was up 7% in a day out of nowhere. So that thing started rocketing up. So you might want to wait and be patient there. But there's also other ones, okay, that we talked about, and we talked about individual China ETFs too. But if we look at a large term chart too of the Shanghai Stock Exchange, SSEC, I want to call out this. This is a quarterly time frame. Look at that. All right. This is long term. This is dating back to 2008, a gigantic pennant. Okay, so you can see expansion, contraction, boom, 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 boom. So this doesn't mean that it's bullish and going to break out to the upside, but you want to pay attention to this because if it does start breaking up, it could start a bull market, which we haven't seen really here because it's been going sideways. But if it breaks down, watch out because it can also be treacherous in obviously the China equities as well. So something to pay attention to, something to keep an eye on. I hope today's episode helped you out. I hope it gave some insight into the VIX, different quarterly charts, certain levels that I'm looking at. I know it was a lot of data, but it is what it is. I'll see you back here on the next episode, everybody. Bye.